As the Federal Reserve looks to hike short-term interest rates for the first time in about 9 years, what would higher rates mean for your investments? Brian Rehling is the co-head of Global Fixed Income Strategy at Wells Fargo Investment Institute and joins me now. All right, Brian, let's start off more broadly. If I'm holding cash in a savings account or a money market account, a bump up in the Fed's funds rate could push interest rates in these accounts higher.
Yeah, it would be good for savers, although the benefit is going to be quite small as the Fed's going to go very slow here. So cash will continue to underperform inflation, but it's better than zero, which we've seen over the last several years.
All right, now higher interest rates may help or may cause investors to take on a little bit less risk, and that could bode well for retirees, right?
Well, we've seen a lot of clients really extend themselves in this zero interest rate environment, taking on a lot more risk than they normally would to generate income. And as interest rates slowly rise, investors should be able to dial back that risk, maybe get more appropriate with the risk tolerance that suits their investment style. So that should be a good thing for savers and retirees.
All right, now the Federal Reserve's initial rate hike is likely to be small, say 25 basis points, but over time we'll see interest rates go up, and that could threaten the values of some of those long-term bonds out there, right?
Potentially. The Fed only controls short-term interest rates, but they're likely to see those long-term interest rates move up a little bit as the economy continues to improve. So investors should take care not to be too overextended or overweighted in those longer-term bonds. Those areas they may have been reaching to pick up some yield, you could see some bigger price movements there.
All right, now many investors are worried that higher interest rates will threaten stock prices, but you actually say a higher rates is an endorsement of the economy, right?
Absolutely. We're talking about very small rate increases. They should not have a significant impact on the earnings power of companies out there, and quite frankly it may be and is likely an acknowledgement by the Fed that the economy is getting stronger. And while we may see some volatility around that announcement long term, we're still in an expansionary period, and that should be good for stocks.
And perhaps the most important impact from higher rates is related to the housing market.
Yeah, that's right. Where a lot of investors are going to see an immediate impact in higher short-term interest rates is in borrowing costs. Credit card loans, those loans tied to prime rates or other short-term rates, you're going to start to see those tick higher, and those payments are going to start getting a little bit more expensive for those that have taken on debt.
All right, Brian, we'll leave it there. Brian Rehling from Wells Fargo Investment Institute. Thanks very much for your time.
Great. Thank you.
I'm Scott Gamm, and you're watching The Street.